Hey, I'm Jason, and this is Supply and Demand Daily, where I tell you what we learned about the economy today. We got some good data releases today. As you probably know, if you're familiar with this little show thing, Thursday is the day that we find out about weekly unemployment claims, so we got some data to go over there. Now, this is also the day that the Bureau of Economic Analysis released its second revision, or no, excuse me, actually its first revision on the gross domestic product numbers for the first quarter of 2022, which if your line of work doesn't frequently deal in quarters and things like that, you can think of that as the quarter that ended, or the 3 months that ended March 31st, 2022. And it was revised down a little bit, but only by a hair. So we're going to talk about that, and I'm going to put into perspective exactly what that means. And then lastly, we got another sort of blowout when it comes to the housing market. As you know, I've been sharing some information about how sort of weak the housing market has looked in the last few months relative to the big pandemic bubble that we saw. And so we're going to talk about what happened there. So in order to do that, I'm going to get out of the way so I can show you some stuff, and we'll get right into it. So jobless claims. Here with the yellow line, what I'm showing is the regular headline number of jobless claims. So this is not statistically adjusted in any way at all. It's just the raw number. Now, there tends to be a lot of volatility with these jobless claims, and there can be some fluctuations week to week that don't necessarily mean a whole lot. And so a lot of times what people will do is they'll look at the 4-week moving average in order to get a better idea of the directionality in this particular data. Now, when you are in the middle of an economic recovery, which we are, because our gross domestic product and our industrial production has just barely surpassed the level of the pre-COVID-19 pandemic and the economic lockdowns that were instituted as a result. But the aim in terms of creating a healthy economy is to get back on the pre-existing trend that the economy was on prior to that date. And so the economy should be considered fully recovered when it reaches its prior trend of production and employment and all of those kinds of things. And so what we want to see right now, and what we should be seeing, is jobless claims that are basically going straight down, or should basically flatline. And we should see total employment continue to rise on a solid linear trend. That's what we need in order to get back to that point. We need to see total employment continue to rise. And a few days ago, or maybe it was last week, I noticed and reported that that's not necessarily what's happening in the labor market, given the unemployment rate for April. But now we're seeing a similar type of data point data phenomenon in the jobless claims. So I mentioned that last week was the 6th straight week in a row, which is redundant of me to say that, but the 6th straight week that the 4-week moving average of unemployment claims has been going up. Now, it's going up gradually, mind you, but if you look at this chart here, I mean, when I was looking at it earlier, even I can see that there is a clear trough and maybe an uptrend building back up again. And it's not necessarily, this line doesn't necessarily need to keep going down in order for there to be a healthy labor market. I mean, you're always going to have a little bit of unemployment and people going on and off of it. So a 200,000 range, and it's staying in the range of maybe 180 to 220 or something like that, would probably be healthy. But to see it going one direction or another, especially in the upward direction, now that's definitely not a good sign. And now given today's release, we found out that the week ending on last Friday, which I believe was May 20th, so in the week ending May 20th was actually the 7th consecutive week of the 4-week moving average being on the rise. So something to pay attention to there. So I have the initial unemployment claims, not the average, going down by 3.7%. That's good, but it's still definitely within a range that keeps that 4-week moving average going upwards, so which is now up by 3.6%, or was last week. Next thing that we're going to go to is gross domestic product. So gross domestic product is the sum total of all of the spending that gets done from various sources in the economy. So we have government, we have consumption, we have investment spending, we have net exports, and then what takes out of that pool is taxes. So we have government spending plus consumption spending plus investment spending plus net export spending plus or minus, taxes. That's what makes GDP, and it's a statistic that's designed to measure how much production, how many goods and services are produced in the economy throughout the year. And so we found out on, I believe it was towards the end of April, that the growth rate in GDP had actually been negative in the quarter ending March 31st. And so the way that these data releases work is that what we were seeing at the end of April was what's called an advance release. So the Bureau of Economic Analysis will tally up their data and they'll put out the advance release, and that gives you an idea of what the growth rate was. And then after that, they receive even more data because it takes time to count up and basically format and put all of this data in where it needs to be and organize it and clean it, check it, do sanity checks, those kinds of things in order to find out what the real number actually is. And so they have done that, and then once they do that, that's when the revision is released. So if you look at the reports, there's a little R next to it, or there might be a little A, if it's the advanced report, but that's not necessarily important. Now, what was the difference here? So we're looking at a difference of negative 0.1%. So the BEA reported that the economy had contracted on an inflation-adjusted basis in the first quarter by 1.4%. Okay, by 1.4%, and then the revision, after all of that extra data comes in and gets tabulated, is negative 1.5%. Now, to put this in perspective, the U.S. economy as of the last quarter in 2012 dollars, so this is adjusted for prices as if it were 2012, so that's the base year that they're using, is about $19.7 trillion. And so if you shave off about 0.1% of that, you end up getting $19.7 billion. And then to further put that in perspective, what does this loss really mean? You're looking at $65 less transactions per human in the United States. So the United States has a population of about 320 million. And so you take that 19.7 billion and you get about $65 less in spending per person in the United States. So not a really big revision by any means, but it does tell us something about the general direction of the economy, because usually when you build into recessions, what ends up happening is these revisions definitely start to go downward. And then when the economy is really hot and going really strong, and the labor market indicators will do this too, but you'll come back and see the revisions and they'll actually be higher than they were before. So we're definitely in the former of those situations today, unfortunately. But moving further on, another couple things. The BEA commented, they always put a couple of things in their releases, and they commented that in the first quarter there was a resurgence of COVID-19 cases from Omicron variant and decreases in government pandemic assistance payments. I just found that interesting because there's always a reason given by, whether it's the financial media or just the regular media or the Bureau of Economic Analysis or what have you, about why, the economy appears to be not performing well or why a particular indicator is not performing well. And I just think this is a pretty weak explanation. I mean, Omicron, the thing that you get and, you're over it in maybe a day and a half and it doesn't feel anything different from a cold. I know people have had more serious cases than that, but it's Omicron, and the pandemic assistance payments have been shrinking for quite some time now, so to blame it on that is certainly not very insightful either. And then just some other things from the GDP report that I found interesting. So consumption spending increased by 2.09% on that's on an inflation-adjusted basis. So there was a little bit more spending in the first quarter. Private investment only went up by 0.1%. So again, that's about $65 per person in the United States in investment dollars. Corporate profits actually went down in the first quarter by $66 billion total. And so that's a drop of negative 2.3%, and then employment compensation went up by $293 billion, which was an increase of 2.2%. So if you have some social media contacts who are all over their Instagram and Twitter talking about how corporations are price gouging and making way huge profits off of the inflation, maybe you just show them this little statistic that inflation actually increased. This is just some examples of that from Public Citizen and Robert Reich, former labor economist. And I'm pretty sure that Public Citizen probably gets a lot of their talking points from Robert Reich. There's definitely a feedback loop there. But, they've chalked all of this inflation up to corporate greed. That's their hip new explanation or whatever. And prices on a consumer, the consumer price index went up in the first quarter of this year by about 1.4%. And then we see corporate profits going down by 2.3%. So that tells me that there's not necessarily a relationship here, and maybe it is indeed what people have known for a very long time, which is that when you print a bunch of money and you dump it into checking accounts and you shut down production, you're going to get a lot of price hikes. So that's what we're dealing with here. So anyway, to move on from that, I wanted to look at the housing market, particularly pending home sales, which came out from the National Association of Realtors. And this is just a little excerpt from the data release that they put out today from the report. These are the 6 months in which it has been falling, or rather, So the sixth consecutive month of decline, and we're looking at a drop of negative 3.9% from month to month from March to April, which is pretty large. And then if you look on an annual basis, we're down 9.1% from the same time from April of 2021. Now, when it comes to home prices, you have to definitely have a lot of activity in home prices in order to keep those increases going. And so there's been a lot of eyes on these statistics of housing market activity. But then the other thing that I wanted to point out that's kind of interesting is that the Northeast region of the United States had the biggest decline of negative 16.2% in a month. And then the Midwest, oddly enough, is actually still growing. So I don't know if that's because people are still moving to the Midwest or because they're moving from urban centers to the Midwest, or what exactly is going on there. Do want to point out that the Midwest is still down by 2.8% from the same time in 2021, but I did want to give some detail on that. And I believe with pending home sales, that is pretty much all we have to go over today. Tomorrow, I'm going to be back with the real disposable income numbers for the United States as a whole. That's been on the decline for, I want to say, 8 months now, since August 2021. So we're going to get PCE inflation numbers as well. That's personal consumption expenditures. And this is the inflation measure that the Federal Reserve Bank uses when they look at the data to determine what their monetary policy is going to be. And so that'll be interesting. And then we have the University of Michigan Consumer Sentiment Index, which has been just absolutely in the toilet for the last several readings. So it'll also be interesting to see what happens there. And I'm at about 13 minutes, which means I'm coming in short of where I have been over the last few days. I hope that you've enjoyed today's Supply and Demand Daily, and that you will join me tomorrow to look at these lovely economic indicators. And as always, if you have any comments or questions or any ideas as to how these little data runs could be done better, or anything that you would like to see cover, do reach out to me via one of the networks that you might be seeing this video on, and I would be happy to talk to you about it. I would love to have some feedback. So anyway, I do hope you enjoy the rest of your day and have a lovely Memorial Day weekend, which I will also tell you tomorrow, because tomorrow's Friday, not Saturday, and I'll talk to you later. Goodbye. Thanks.